This is Capital Success by Chris Shepley, a series where we talk about all things day trading, the world of investing, and how to play the game of capital success. I hope you find value in this. So, what is a crypto exchange? Well, a crypto exchange is a platform that you can go to buy, sell, and trade cryptocurrencies. It's essentially a marketplace for projects, which is coins and tokens. Exchanges come in all forms, shapes, and sizes. There's centralized exchanges, there's decentralized marketplaces, and there's everything in between. So we're going to go through the difference between a centralized exchange, giving examples of them, as well as a decentralized exchange slash marketplace, giving examples of what that is, and essentially identifying what platform is best suited to you and your trading needs. So we're going to start off with what a centralized exchange is. So a centralized exchange, ultimately, it's controlled by a company. It has a center of origin. So, for example, Binance, Coinbase, Crypto.com, Kraken, CoinSpot, the list goes on. And these are all controlled by a specific company. Every name I just listed is a company. And they hold the hot wallet or multiple hot wallets that essentially control all of the projects, tokens, and coins that are available on that exchange. So, pros of using a centralized exchange, is that it's such a user-friendly experience. It's just like when you go to, let's say, a shopping center, or you go to your bank, for example, and you know exactly what you want to get. It's on the shelf, right in front of you. You can scroll through, or in a retail shop, you can walk through the store and say, yep, I want this, this, and this. How much is it? Okay, buy. It is that simple. That is what a centralized exchange is. It's simplicity and it's convenience for the user. So it's the best option typically for new crypto investors. Anywhere in between the years of, I say, 0 to 2 is where I would recommend people start using exchanges and stick to exchanges. Because not only do exchanges offer the convenience, but they also offer an element of technical analysis. And especially for someone who's brand new to crypto investing, and investing in general rather, you need to learn how to identify crypto analysis. The thing I always say to everybody is crypto is the only asset class in the world that is a 50-50 split between technical and emotional analysis. What that means is when we look at Forex, for example, 95% of maybe even 99% of a Forex graph, a candlestick graph, once you identify the patterns, once you gain the understanding through learning over the years, once you identify the patterns, you know almost exactly what's going to happen in the market. And you can point out specific bull and bear patterns. There's so many examples. There's literally hundreds, if not thousands, of different patterns that you can learn. Once again, that is something I do offer on the side to teach. If you follow me on Threads or Instagram or X, I do talk about that stuff daily. Anyway, little plug. Once you understand that it's a 50-50 split, you can learn to identify technical analysis just like the Forex markets, but you also incorporate what I talk about as the emotional side of crypto trading, which is that the market is 50% controlled by user emotions. Because it's such an extremely volatile industry, sometimes as simple posts from a very influential individual on X, or potentially a downtrend in the market when people do not understand how to read the technical analysis. It's what we call FUD, and it trends people follow suit and sell their own portfolios, and the price goes down even further. That's why I talk about crypto being the only asset class that's a 50-50, because emotional traders are everywhere in this industry. And when we relate this back to a centralized exchange, there's a sense of safety in centralized exchanges because an exchange typically only lists products or tokens or coins rather that are you can never call it safe, but they're semi-secure and backed with a decent liquidity pool. What that means as a liquidity pool is that there are multiple thousands, maybe hundreds of thousands, maybe even millions of a market cap / liquidity of coin. What that means is that, let's say there's 100 people and they all invest $100 each, for example. That's $10,000 of liquidity that was just invested into the coin. So that liquidity sits in a what we call a hot wallet, or it sort of sits behind the scenes as liquidity. So for when one of those 100 people or 10 of the 100 people sell their portion or their holdings, it comes directly out of that liquidity, and that is used to fund their sale. So exchanges typically only have tokens and coins that hold safe/secure projects that have a decent liquidity pool. So they're the pros of having exchanges. Again, it's safety, usability, convenience, and speed essentially. But there are also cons of an exchange, and the cons are similar to what I've talked about in the past, but we'll go through them now. So the obvious one is that you're only allowed to trade on an exchange if you hold your wallet on said exchange. And by holding your wallet on that exchange, you do not own your private keys. You do not own your seed phrase, which means you technically don't own your crypto. I've talked about this in the past, but it's a massive con, almost the largest con in my eyes when it comes to holding cryptocurrency, because when you trade on an exchange and you hold your projects on the exchange, you technically don't own those tokens or coins. The exchange holds them for you, just like a bank in the real world. Of course, you're putting your money into the bank in the real world, but you got to think a bank is a business, and you're trusting a business to hold your money. If that business were to go bankrupt or to, for some reason, shut down for 24 hours, you couldn't access your money. It's no different for an exchange. So in essence, there is less control, it's not less safety, but there's less self-reliance and self-sustainability, which is for a lot of crypto traders, especially most people who get into crypto, is all about having self-custody of their own currency, trying to get out of the banking system, eliminate the middleman, i.e. the bank or the exchange, and become self-custodians of their money. An exchange doesn't allow you to do that. That is the biggest con of an exchange. There's a couple more minor cons. For example, sometimes a project might be delisted, or gas fees, which we'll go through in a moment, but gas fees might be higher because the exchange obviously has to make money in some variants, and they typically do that through gas fees. So a quick rundown of what a gas fee is, because this relates to everything, is a gas fee is essentially, for Australians, we'll call it the GST on top of purchasing an item. Or in America, I'm sure you have a GST or something quite similar. I believe you have GST. And same for rest of the world. You have, I think it's called VAT tax. It's similar to that, where in essence you have an item, but there's always either a 10% or a 5% or whatever the fee is for a real world products or service you typically buy. Gas fee is no different. There's a fee to create the transaction. To allow the transaction to go through, there is a gas fee. That's the same for every project, every token, every coin, ever. It won't change. There are projects and coins that have cheaper gas fees. So for example, XRP has, for a $100 transaction, their gas fee is approximately 0.0000001 US dollar. Like, you wouldn't even identify that in your bank losing 1,000th of a cent. You wouldn't know that. But there is still a gas fee. Whereas if you look at notoriously Ethereum is notorious for the largest gas fees in the market. For example, if you have 40 Australian dollars, about 43% of that, give or take, will be taken in gas fees. That's how crazy it is. And there's no minimum. It's not based on a scale between, it's only 2%, 3%. It depends on the busyness of the market at that time. And if the market is extremely busy, that gas fee will be higher, and vice versa. If no one's trading somehow in the market at that given time, gas fee will be relatively low. But Ethereum is notorious for being one of the highest, and the list sort of goes up and down depending on the project. So gas fees are quite relevant to every project, and especially for exchanges, centralized exchanges rather. That's almost a location where they can make their money, essentially, because they are a business. They need to make money somehow. So that's one of the ways they do it. And they sort of round it into the total sale, so it sort of blends in as a tax. The next one is the opposite peer to that. It's a decentralized exchange. So ultimately, peer-to-peer trading, almost removing the middleman entirely. Examples of these are Uniswap, PancakeSwap. Radium is, I believe, the Solana one. They can be different chains, so Ethereum blockchain, they could run on the Solana blockchain. A lot of them multi-chain. but it's all dependent on what projects you're going after. And essentially, a decentralized exchange removes the middleman. So a pancake swap acts as an interface to access the blockchain, and there's no middleman. So, for example, talking about Binance, let's say we're buying Ethereum on the Binance blockchain, or on Binance rather, you're paying a gas fee, and that gas fee is sort of lumped together with the total transaction, and there's also a little portion that goes to Binance as their fee to use their platform. PancakeSwap, let's say, as a decentralized exchange, does not have that, where there's a gas fee, of course, but it's a gas fee that is determined directly from the transaction rather than including business operating fees. So that's one of the benefits of using a decentralized exchange. It gets you one step closer to self-sustainability, which is what typically the crypto investor is looking for. Now, specifically when we're talking about the pros and cons of a decentralized exchange, we're going to start off with the most obvious one. You retain control of your funds, because when you have a decentralized exchange, you're not using a hot wallet, which is a wallet directly connected to the exchange. You're using a wallet such as a MetaMask or a Trust wallet. It's essentially a portal, what I call a portal wallet, that allows you to access directly to the blockchain. And again, that wallet doesn't hold your crypto, it merely acts as a portal. You can log in with your seed phrase and private key to Trust wallet, and then 2 months down the track, maybe you lose your phone, maybe you just want to move on from a different platform to MetaMask. You can just take the seed phrase and private keys, bang them straight into MetaMask, or again, if you lose your phone, do the same thing with Trust Wallet, put it into the new phone, and bang, all your crypto's there, untouched, exactly how you left it. So again, these decentralized wallets act as portals, and all of these wallets allow you to connect directly to most decentralized exchanges, such as Uniswap, your PancakeSwap, your Radium, etc. So you retain greater control of your funds, and it allows you to almost greater access to buy, sell, transfer crypto, either from peer-to-peer or through the marketplace of the crypto project world. But there are cons, and the cons are quite greater almost than exchange, a centralized exchange. It is quite relative, depending if you want to hold your private keys as a centralized exchange. But a con for this one is that there's less security, and what I mean by that is, I mentioned before that typically centralized exchanges typically list projects with high liquidity and relatively safe backings. Decentralized is peer-to-peer, which is also essentially means it's peer-to-peer created. So the everyday person can create a project or a token and list it on a decentralized exchange. So those projects, you've typically heard about them as meme coins or passion projects. These projects are what listed on a decentralized exchange, and there's absolutely millions of these projects out there that are rug pulls that people make, and within 20 minutes of listing, if people invest, they rug pull it, take out all the liquidity, because the creator of the project will probably hold a greater portion of the total supply, and they'll pull liquidity. So it's extremely risky. It's a lot less safe than a centralized exchange, where that safety backing is always in play. But that is the risk you take for decentralized exchanges. Some people call a decentralized exchange more complex to use than a centralized exchange, which I understand. It absolutely is. There's more features, but I almost consider it the difference between phones from 1990 to today. A phone used to be on the wall with a cord, you press a button, or even less, you spin the dial to the numbers, bang, you make your call. These days, you know what a phone is. It's a touch screen. You go on every single app in the world. You buy, sell, you bank, you call, you message, you snap, you do millions of different things compared to 25 or 30 years ago, rather. So this is sort of what I mean when I'm talking about, centralized versus decentralized, the complexity between each. A centralized exchange is straightforward. You buy this, you sell that. Whereas decentralized is a bit more interaction, customization to user preference. And if you understand how to read the exchange, how to utilize the exchange abilities, then that's not really an issue. But it is for the typical brand new investor. So that's always something to keep an eye out for. So now that we've identified what a centralized and decentralized exchange is, let's quickly go over some of the basic projects that are typically listed. So on a centralized exchange, you'll find projects that are highly popular. You've heard of the Bitcoins, your Ethereums, your Solanas, your Ripples, your Sui, your HBAR, your Chainlink. All of these projects are very well known in the crypto space, and they are most often than not listed on these bigger centralized exchanges, whereas your decentralized exchanges still have the ability to transact majority of those I just listed, but are more to do with, again, peer-to-peer created / traded project. And what I'm referring to is meme coins and basic utility-less coins that are either named a crazy dog name or a crazy frog name. You get what I'm saying. The benefit of those is that, again, from a investor's perspective, allegedly, there's a greater chance of going from a $1 investment to $1 million because of the volatility in a meme coin. That's absolutely true, but there's even greater chance of losing that dollar within the first 30 seconds of investing. So for some people, it's almost the gambling of the crypto world. But that essentially is all found in the decentralized exchange. So it comes to user preference between decentralized, trying to almost gamble the market, and centralized, where it comes to just investing in well-known cryptos. And I've talked about in the past as well, you can always go on a centralized exchange, buy your highly well-known projects such as your Bitcoins, Ethereums, etc., and then transfer them to a self-custody cold wallet, also known as hardware wallet, to self-custody your crypto. That is absolutely something you can do. And I've talked about that in the previous podcast called What is a Crypto Wallet? So if you haven't heard about that yet, go check that out after this. So it all depends on what your investment desires are. But essentially, I would typically recommend people stay clear of decentralized for the first at least 2.5 years, or at least to a point where you understand the crypto industry in general. What I mean by that is, even if you're a brand new investor, absolutely spend the 2.5 years learning how to read technical analysis, understanding crypto, understanding what projects are, utilities, etc. But even if you are an ex-Forex trader, like I was a Forex trader prior to crypto many years ago, it still took a moment to understand that the markets do not move the same. Yes, technicals still go up and down, following chart patterns, etc. That is still true, but like I said before, I believe it's a 50-50 split between technical and emotional analysis. And for a Forex trader to just take all their Forex technical analysis skills and bring it into a crypto market, you will learn pretty quickly that it doesn't work like that all the time. So, my tip is to stay on a centralized exchange for the first few months to a couple of years. And then once you feel comfortable identifying the industry, trends, moving trends, etc., stock flow models, everything to do with the crypto asset in general from a technical and emotional analysis, then I would recommend, if you want to, that is, looking at the decentralized exchanges, what they have to offer, what are the utilities, staking, all that sort of stuff. That's the play up you have, an investor has, between a centralized and a decentralized, and it's typically up to you to figure out what you want to get out of crypto. Key tips for beginners, and this is what we're going to end on, the 5 key tips for beginners. Once again, this is all not financial advice, but this is just my 5 key tips. Start small. Only invest what you can afford to lose. Do not go into crypto with the same wallet / portfolio / capital as you would for Forex, for commodities, for stocks. You will lose it most likely unless you know what you're doing in crypto. It's a different beast. You will not perform the same. You will stuff up. I stuffed up. Everyone I've talked to stuffs up. Everyone I've known who has ever invested in crypto has stuffed up before. It is not the same as Forex. The second one, always use a reputable wallet and exchange. You can go on websites such as CoinGecko or CoinMarketCap or other websites similar to that, where they list exchanges that are on the market, both centralized and decentralized. And on there, you can find your Binances, your Coinbases, etc. You can also find your decentralized ones, such as PancakeSwap, Uniswap, and Radium. They're fairly safe as well. Tip number 3, always enable two-factor authentication on your wallets. Whether that's a hot wallet for an exchange, when you log into your exchange account, it's slightly different when you get a username and password. Two-factor authenticator always. That includes transactions. Because if you lose your phone, for example, You do not want someone to transfer out of the exchange into their own cold wallet, for example, because technically you could track where the trade goes, yes, but you'll never get it back. And because crypto is a bit more secure and doesn't exactly say a name of the person you invest it to, you will not get that back, and you'll most likely not find out whoever stole it from you. And when you use a decentralized exchange and you connect your wallet to it, always disconnect your wallet directly after use. Never leave it permanently attached to an exchange that is decentralized. The risk of theft is just as high, if not higher, than a centralized exchange. Tip number 4, research before trading or investing. Knowledge is power. I talked about this so many times already. Know what you're investing in and why you're investing in it before you invest in it. Do not go for, and this is my recommendation, do not go for meme coins. You will lose your money. There's just no point. And everyone who you see online who posts saying, I put $30 in and I made $3 million, it's not true. It's Photoshop. It's fake. 99.9% of people do not do that. It is fake. Yes, the odd person has done it before. 1 out of 1,000,000, 1 out of 100 million. It is that rare. Do not think you're the 1 in 100 million. It's not going to happen. And the final tip, which is the most important one in the crypto space, never share your private keys or recovery phrase to anybody or any business or any exchange or anybody ever. As simple as that. Hopefully by now this has given you a far greater understanding of what the different exchanges are, and hopefully it allows you to make a well-informed decision as to what will benefit you and what will be the best option for you moving forward. My name is Chris Shepley. Thank you for listening, and as always, trade smart.